Good morning. Gosh, that's loud. It's a great pleasure to be with you here again and to be back in Cape Town despite the weather. Last year I spoke about the MAGA master plan in a talk that was entitled Method in the Madness, and a year on it certainly felt a lot more like madness than method. And in a rapidly changing world, we often talk about geopolitics as if it's the starting point for economic and financial systems. And in reality, it's usually the consequence. Since the end of World War II, the rules-based order was built around US industrial and financial dominance, held together by the US dollar as the global reserve currency and the US treasuries as the global reserve asset. As that system becomes strained, cooperation gives way to competition, rules give way to power, and the world begins to look, well, historically, quite a lot more like normal. So this morning I want to take a step back from these immediate headlines and look beneath the surface to two underlying forces that I think will shape returns over the next decade and beyond. They are the engine and the constraint. We start with the constraint. We are living in a world with too much debt. This is not a moral judgment, it's a mathematical one. By some estimates, global debt has now reached around 2.5 times global GDP, a level that cannot realistically be paid down in the normal way. The best we can hope for is to slow the rate of increase and manage the consequences. US government debt is by far the most important due to its role as the global reserve asset, and it's growing at an eye-watering pace. In just 1 year, the US has added about $3 trillion of debt, taking its total to roughly $39 trillion. The interest bill alone is approaching $1.25 trillion. Put that in perspective, it's 3 times the entire South African economy, just in interest. And every year, the debt levels are accelerating. But high debt is not uniquely an American problem. Governments, households, and corporations across the developed economies are more leveraged than at almost any point in modern history. And importantly, this debt has built up during periods of unusually low interest rates and unusually supportive financial conditions. That matters because it tells us the debt cannot easily be grown out of. For the past 2 decades, using ever more debt to stimulate growth has been the norm. Increasingly now, debt itself is becoming the constraint. The fundamental problem is not just how much debt there is, it's what it's been used for. Debt, of course, can be very productive. Borrowing 3 times your income to fund a property is normal, or to invest in infrastructure or productive capacity. John Maynard Keynes argued that governments should also stabilize economies by borrowing during downturns and repaying it during expansions. The problem is when borrowing becomes the routine financing of day-to-day spending with no productive assets behind it. That is not a mortgage, it's a credit card. Governments of all colors have given up any pretense of trying to balance the books. Over the past 50 years, the US budget has only achieved a material surplus for one brief period during the dot-com boom nearly 25 years ago. Deficits have become structural, not cyclical. Borrowing has become normalized. But there is a limit, a tipping point, where the rising cost of debt becomes inescapable. Then there are only 4 ways out: austerity, taxes, growth, or inflation. And history will tell us which option tends to be chosen. The root of the problem is, of course, persistent growth in public spending that has expanded faster than the political appetite to pay for it. On this metric, the US is actually positioned better than many, with public spending around 34% of GDP. Public spending in much of Europe is approaching or even exceeding 50% of GDP, such as in France, Italy, and Germany. From these levels, the scale of austerity required to balance the books has become politically unimaginable. Even where there is capacity to reduce the deficit through taxation, this too is politically very challenging. Both austerity and taxation have direct and immediate impact on living standards. So in practice, policymakers tend to take an easier path. This is the US debt again, but this time relative to GDP. And notice that despite the absolute levels of debt rising at an unprecedented pace, the debt to GDP ratio has actually remained fairly flat in the last 2 or 3 years. But growth has been quite weak, so how can this be? Well, what matters here is not real GDP that we normally refer to. It is nominal GDP growth, which is real growth plus inflation. And inflation has been running at around 3%, so nominal GDP growth has been rising at 5% or more, meaning the US can get away with a 6% deficit without a substantial increase in this debt to GDP ratio. Note also that in the period after COVID, despite absolute debt levels rising by 70%, the subsequent inflation spike had the effect of actually reducing the debt to GDP ratio from its peak. This is, of course, a sleight of hand. We all know how painful that inflation spike has been to our living standards. Inflation in this context is nothing more than a hidden tax that compounds over time. Faced with this level of debt, policymakers everywhere have made a remarkably consistent choice. In broad terms, there are 2 paths. Path A is textbook. It's fiscal discipline, monetary restraint, lower inflation, and stronger real growth that lifts living standards. But fiscal discipline is painful, and achieving real economic growth simply cannot be engineered at the command of any government. So path B becomes politically expedient. Tolerate higher inflation as a hidden tax, run larger deficits, and prioritize nominal growth over balance sheet repair. Policymakers everywhere have chosen some version of Plan B. They have chosen to run the system hot. This is not an accidental mistake, it's a rational policy choice, and broadly we must expect it to continue. Milton Friedman observed that inflation is always and everywhere a monetary phenomenon. And in practical terms, run-it-hot policies means looser monetary and fiscal policy funded by borrowing that expands the money supply faster than economic output. And that is exactly what we've seen. This chart shows US money velocity. That's the number of times each dollar is used in circulation in the US economy. And since 2000, the velocity of money has slowed markedly. It's a clear signal that more money has been created than is actually needed for the real economy. When that happens, the excess money tends to flow in 2 directions, into consumer prices and into asset prices. The run-it-hot policy tends to favor asset owners, rewarding capital over labor. It's a policy that fuels inequality, and that creates political fragility, which in turn feeds back into more policy, regulation, public spending, and risk premia, usually at the expense of growth. This is the deliberate policy that I would call debasement, the gradual erosion of purchasing power that acts like a hidden tax. Since 2000, US inflation has roughly halved the spending power of US consumers. And over the very long term, inflation has eroded purchasing power by 90% or more. Debasement does not require a sudden crisis event, a monetary reset, or currency collapse. It's usually slow and persistent. Nominal values rise faster than real purchasing power year on year. It's a process, and this matters enormously for investors because it changes the question we should be asking. The question is not, will the US dollar survive? In my view, it almost certainly will, not because the US position is strong in absolute terms, but because every plausible alternative means dealing with equal or greater problems. There are simply no credible alternatives. All major currencies are being debased in a similar way. So the real question is, what should we measure success in? Purchasing power is ultimately what matters. So, is gold the answer? Gold is a unique asset. It's scarce, enduring, and for centuries has preserved purchasing power as a store of value. But it's important to be clear about gold, what gold is and what it's not. Gold is insurance and a store of value. It is not a modern monetary system. A strong economy with stable prices requires money supply to expand roughly in line with economic output. Gold's greatest virtue, its scarcity, becomes its undoing as a monetary system. A return to a gold-backed money would require an extreme monetary contraction with severe economic consequences. Bitcoin fails for exactly the same reason. Gold has limited productive uses and a cost of ownership, so over the longer term, productive businesses that innovate, reinvest, and compound should still outperform. But that does not diminish gold's appeal. In an environment of persistent debasement, gold should continue to appreciate and maintain its purchasing power, particularly relative to nominal promises like debts, like bonds and cash. Its role as a reliable inflation hedge and insurance asset has driven strong central bank buying and passive investment flows, making it one of the best performing assets since 2000. And it now trades 2 standard deviations above its inflation-adjusted average. But then everything is expensive. Equity valuations are at historic extremes, as are property prices, commodities, and many real assets. In an environment of excess liquidity and persistent debasement, we cannot judge valuations by historical norms. So long as the liquidity keeps flowing, valuations can keep rising. This is the investment paradox of run-it-hot policies. It can drive the strongest periods of investment returns, but with every step up, the system becomes more fragile until quite suddenly, and often for no apparent reason, the music stops and we discover there are not enough chairs. I will be honest with you, this is exactly where we are right now. Financial markets look vulnerable. A credit shock is no longer just a tail risk. A market reset is increasingly plausible. There is only one clean way out, and that's productivity. Achieving more output for less input. Economist Paul Krugman famously stated that productivity is almost everything, and he was right. If debt is the constraint, then productivity is the engine. The good news is that we have seen many productivity revolutions before. They tend to come in waves and on the back of technological breakthroughs. And when they arrive, they can change the macro picture faster than people expect. In the late 1990s, the dot-com productivity wave fueled rapid growth and a rare period of fiscal surplus. Historically, it is productivity that has allowed societies to carry higher debt loads without social breakdown, not through austerity, but through real rising incomes. Productivity is the only genuine win-win scenario. And if you take only one thing away from this presentation, it's this: to view everything through the lens of productivity. your personal productivity, your business, your investments, your government. Productivity creates prosperity. Artificial intelligence now offers the promise of a productivity wave, the speed and scope of which we have never seen before. And we need it now like never before. It's not just a tech story, it's become a macroeconomic necessity. Let me be clear, I don't think that it's a question of if there will be an AI productivity boom. Each of us now has a new superpower, emergent reasoning from the sum of all human knowledge. Easy. It's an engineering marvel. In my view, it surpasses anything that humanity has achieved previously. And AI is not just a technology upgrade. It's a general-purpose productivity tool that affects decision-making, design, logistics, research, and capital allocation all at once. The only question is, can it come soon enough to avert a credit crisis? It is now a race. But disruption on this scale is, by definition, unpredictable. Investors must be humble enough to know that picking winners in transformative cycles is almost impossible. The classic historical example is the automobile, a genuine productivity revolution of its time that spawned over 2,000 new car makers. Only a couple survived, and most of those actually reinvented themselves. The only thing we could actually predict was that the horse and cart business was over. So don't confuse the inevitability of the change with certainty about which business models will succeed. Very often, the most predictable outcome is not who wins, it's what becomes obsolete and what also becomes scarce. This is the conundrum with valuing the hyperscaler giants today. The scale of the investments going into AI data centers and chip technology is astonishing. But it's not yet clear how or if all that capital investment can generate sufficient return. What we do know is that AI will disrupt almost every area of the economy. And while we may not know which firms will win, we can better see which constraints will bind and what parts of the value chain gain pricing power. As digital processes become cheaper, the bottlenecks move back to the physical world. Energy, materials, infrastructure, skilled capital. These are the structural requirements that you can invest in. We don't need to predict winners precisely. In this new era, we need to identify what becomes scarce and therefore more valuable, and what becomes more abundant and therefore less valuable, such as software. These are the two great mega themes of our time: AI superproductivity versus debts and persistent debasement. In the near term, financial markets remain vulnerable to a credit-driven reset, likely starting in private debt markets. But in the longer term, productivity always wins. So let me close with 3 investment implications. Firstly, nominal promises and debts are fragile. You should be cautious of exposures that rely on cheap financing and abundant liquidity. Second, real scarcity is changing. Look for assets tied to tomorrow's real constraints: energy, infrastructure, critical materials, skills. And finally, seek productive businesses with purchasing power. But choose carefully. This is a time for active management. In a world that is drowning in debt, productivity is the only escape, and capital will flow to those investments that can deliver it. Thank you very much.